Vice President and Senior Investment Advisor of Canaccord Genuity Wealth Management and Goernert Wealth Management, and welcome to my channel where I help you make sense out of your financial world. Now, today I'm going to be joined by Martin Roberge, Canaccord Genuity North American Equity Strategist. But before we get started, coming up next Wednesday, if you're watching this before then, it is coming up on September 16th at 10 a.m. I have my tax-efficient retirement investing strategy webinar coming up, where I'm going to be joined by Vice President of Taxation from Fidelity, Peter Bowen. It's going to be a fantastic show. We've got a couple of spots left. Webinar is 10 o'clock Pacific Standard Time. Really want to get a hold of this because over the past 6 months since the COVID crisis hit, governments across the world, in particular in Canada, we have run up just a mountain of debt. The deficit in Canada, the federal deficit in Canada this year is about $1/3 trillion. Now I can tell you, they're going to come looking for that money, and they're probably going to come looking at you and me. So we better get ahead of this now. So if you can, email me in the show description there. My information's there. If you'd like to join the webinar, it's going to be a lot of fun. I think we'll have our eyes opened, but it really is important that we get ahead of this. So before we go any further, I'm going to turn it over to Martin Roberge. Well, my guest today is Canaccord Genuity North American strategist Martin Roberge, joining me from Montreal. Martin, how are you?
I'm good, thank you, Greg.
Well, hey, I'm really glad to have you on the show today. A lot of things are happening in the marketplace right now. The FANG stocks and the technology stocks have been particularly falling off over the past little bit. And I know you put a note over the past little bit saying, "Hey, is this the correction?" And what do you see going forward? You know, typically October is a nasty month in the equity markets, and just maybe take it from there and where you see things going from now.
Yeah, actually. September is the worst month of the year from a seasonality point of view. But October, through an election year, October is more challenging. And as you know, we're going through an election this fall. So obviously, there are some factors, or seasonal factors, providing maybe some tailwinds to equities, But the one thing we have to remember when it comes to investing is where we're positioned, or where we are in the business cycle and in the stock market cycle, and our understanding is that we are beginning a new business cycle. This one will be very muted and probably last shorter than the one we had from like 2009 to 2020, and whenever we get a recession, obviously this one is different than the one we had through the global financial crisis. There's always eventually what we call a post-recession rally from the recession lows, and this rally is usually very powerful, and they last anywhere between 6 and 9 months, and we got to that point earlier this week, last week, and now we're done through what I would call the rapid phase of the cyclical bull market. Now we're going to go through a transition to what I call the slow growth phase of the cyclical bull market. And whenever there's a transition from a rapid phase to a slow growth phase, there's always market volatility, as investors are looking for a change, maybe in market leadership, new leaders, or just that the leaders of the previous ramp are just tired and overbought, which I believe is the actual backdrop. So for me, the volatility we're seeing is more akin to a pure technical sell-off that we normally see 6 to 9 months after a post-recession rally. And it doesn't mean that we won't have a bigger correction down the road, but a pullback, whether it is a pullback or a correction, we're still in the camp where we want to buy the dips for probably another cyclical advance that will take the market to new highs somewhere around spring or next summer, and that leg, like we don't want to paint ourselves in the corner, but that leg could eventually be like the final leg or one of the last leg we have in this bull market.
Oh, interesting. So I know you were making some analogies when we were talking last about maybe 2009 being something to be taking a look at after we came out of the financial crisis, and some of the analogies with the market bouncing up and moving back down. I know that you've got some equity performance numbers that we've got, and you come right out and say that U.S. equities are kind of looking like 2010. Do you want to expand upon that and how that affects the overall economy and the markets, and just your thoughts on where we could be from here?
Yeah, that's 2010 is a year from the recession bottom that we saw in 2009. So that's the market became extremely extended, and we had several pullbacks early 2010. Then mid 2010 when we had the Greek debt crisis.
Yeah.
So and then we had also another big correction in 2012 when we had the European sovereign debt crisis. Yeah. So there will be stop and go rallies, and there will be rolling corrections, and the key for us is to make sure that when we believe that there's a 10% plus downward move coming, we tend to be more conservative in our equity or asset mix allocation. But in order for us to call for like 10% plus corrections and possibly bear markets, we need to see outright bullishness. Obviously, we've seen some of the technology high flyers doing extremely well, but this is one portion of the market. It's not the overall market. Usually the market is crowded, both on the growth side and on the value side at the tail end of a cyclical bull market. And we're missing the value part of the equation. This is not to say necessarily that value stocks will take over growth in terms of leadership, but they need to probably participate a little bit more to what we've seen so far in this cyclical bull market. And normally, when we get saturated, both growth and value stocks are trading at very high multiples, and we're not yet there. Right. So maybe, as I said before, maybe this is a story for next spring, but for now, we believe that value and growth will continue to participate to this rally.
Now, what are your thoughts on money supply and interest rates going forward underpinning this? Because we continue to be printing a ton of money, and the average person on the street looks at the economy where we're at right now, and in some cases sees the S&P 500 have this big recovery, but have they been stripping out in their minds the effect that the technology stocks have been having on the S&P 500, or is that something we want to talk about? Just the market recovery, it's been accentuated by the technology stocks, and I'm just wondering, when they start coming off, how do you put those into your models?
I think if we look back at technology for the viewers that are listening today, and if they were around in 2000. We had this rotation out of what we would call back then the new economy stocks into the old economy stocks. Yep. And the rotation began in March 2000. And then we had when these stocks, the dot-com stocks, fell apart, they took the market lower. Okay. Yeah. Even though value stocks were resilient, they were not big enough in market cap to offset the decline in dot-com stocks. So the overall S&P 500 corrected by 11% from, I believe, March 2000 to May, July 2000. And then we had this ramp that lasted until December 2001, where value took over, or old economy stocks took over growth or new economy stocks. And this extended the bull market by another year. This is exactly how I feel right now. If you allow me, Greg, to use this roadmap, this is how I feel. The only difference is that back in 2000, 2001, global growth was very, very strong. Right. So you could make a case for investors to rotate out of growth stocks into value stocks. This time around, global growth is weak, improving, but very weak. So I doubt that there's enough growth out there for cyclicals and, well, not cyclicals, but value stocks like financials, like bond proxies, for them to shine. So I'm not willing to tell your viewers or listeners to dump all their technology and rotate into value. Actually, I've been taking the other side of the coin. I've been lucky with this call, but right now I would probably reduce the quantum of my investments in growth and start adding more into the value, but not as a one-way bet to sell all techs and go all in value. Right. I think we have to have a more measured mix between the two groups. And this is how I see the market moving for the next 6 to 9 months. So again, when you have a debate or a tug of war between the two groups, there is some volatility, but at the end of the road, the path of least resistance is usually up.
Right. Now, the other thing you brought up, just on the general economy, that you've been seeing that order books are firming on North American machinery. That's got to help underpin things, because I know it's a slower growth scenario than maybe some people were hoping. But how does that play out with machinery outlooks?
Well, that's the Caterpillar, the Finning, the Toromont, all the major drilling, all the equipment makers, drillers. Those will benefit, and it's not only like if you look at the starting point of those firming orders, it's coming from China. Like China is heavily stimulating its economy. Okay, we've seen fiscal packages around the world, which is also stimulating regional economies, and as a result, we are seeing also higher commodity prices.
Well, we've definitely seen that on the copper side.
On the copper side, we've seen it like lumber a bit, like iron ore. Oil has its own problem, but we're gold is done well. So, energy, the commodity complex has done extremely well. So now we've seen a lot of financing in, for example, the junior mines, mining stocks, and this money will be redeployed eventually as companies are ramping up their production, because there has been a dearth of expansion or new exploration over the last couple of years. So mine supply, for example, is going down, and this new money that we have just raised will probably be redeployed to expanding again. And the machinery equipment makers are such as Caterpillar, are very well positioned to capture some of that money along with the smaller players. So we really like that group, and we upgraded the group to an overweight stance this morning.
Okay, that's good to know, because that's something I think some people forget, is that if you're a metals producer, like say copper, for example, you're taking it out of the ground every year, and every year you're getting deeper in the ground, which makes it more expensive, and you have to replace those reserves. And there was a number of years there, a good long time when coming out of 2011, where there was no exploration money going into the ground, and I still think it's starting to improve, but you've had a situation where the major producers have looked at their exploration cupboards and realized that they're kind of getting empty, so they've got to go out and do some work to refill those reserves. That's a good point that you said about Caterpillar and all the Toromont and the others in that sector. So what other sectors right now are you focusing on that you really quite like?
Well, I'm like if I look at themes, that I push to institutional investors. I like what we call the economy sensitive sectors, industrials, materials.
Yeah.
Those two, I like them relative to financials.
Yeah.
Financials are more interest rate sensitive, but rates are so low. I'm not in the camp of those strategists recommending the financials. I don't dislike them, but I think it's dead money. Yeah. So I prefer, in terms of cyclicality, remain exposed to those sectors sensitive to better global growth momentum. Okay. Yeah. So industrials, materials, within those sectors, I still champion the miners. I really like the base metals. I like, they've done well since the bottom, but I think they will continue to do well. I still like fertilizers. Okay. Yeah. They have not done that much. So Greg, I'm trying to buy low and sell high here. Okay. No, exactly, this is a sector that hasn't done that much, but we believe like the CF, the potash, and the mosaic, like our group of stocks that will continue to do well as we've got rising food inflation issues over the next several years. I still champion the golds. They've done well.
I was going to ask about that, right? Yeah.
Well, maybe we can talk in a few minutes about the golds, but this is a sector that will continue to do well. As I said, I like machinery. I like the rails. Rails have done well, but that's because only the online sales.
Right.
But they have the what's coming is the pure inventory rebalancing, where if you look at U.S. retail sales, they are at a record high, even though we have this recession. The government checks were so positive that the consumers have gone out and spent that money, so that retail sales are been so strong that inventory levels are too low. So there's another manufacturing cycle coming where retailers must replenish their shelves, of goods, and the transportation of goods from manufacturers to retailers will trigger more carload traffic. So rails will benefit, and no wonder that Kansas City is up for not on the sales block, but in the U.S. there's a takeover attempt by a private investment firm. So I really, really like the rails. They've done well, and those are the cyclical areas that I like. In what I call the more defensive areas, I still like the healthcare in the U.S. Sector. Huge pandemic beneficiaries. They got killed a bit because historically, when Democrats win, it's usually negative for pharmas, biotechs, and medtech, but it's already discounted. We've seen the Biden win has been discounted in healthcare stocks. So I really like this sector, and the other ones that I still champion, even though we reduced our weighting this morning, is on the household products. Colgate, Palmolive, Kellogg's, U.S. staple names, like steady as she goes. Like they are not really affected by the cyclicality of the economy, and they remain really good stocks valuation wise.
Interesting. Well, I mean, those are all good signs, just as for the market as a whole. Let's just circle back and touch upon gold, because we wanted to expand upon that just a little bit more, because you were one of the first guys out there to be really pounding the table a couple of years ago. It's had such a good run. It's taking a bit of a rest right now. What are your thoughts on where we are from here?
Yeah. As we discussed in maybe a previous show, gold, like bull markets in gold, have always two phases. The first phase is usually driven by fear of a recession, what we call deflation fears. And in this environment, the gold and the gold equities can do well despite a strong U.S. dollar, because people hide in the U.S. dollar if they're scared. So it's not abnormal to see golds doing well when the dollar is strong if you're in phase one, which is exactly we've been up until this year,
Right.
when the Fed began to slash rates, okay, and then lately give up on their inflation strategy, basically confirming that rates will be at zero for at least the next 2 years,
Yeah.
and they will be willing to take an inflation risks
Yeah.
to get the expectations higher, which is key for the price discovery of several goods. So this rising inflation expectation cycle is phase number 2. Okay,
Right.
we're switching. We have gone from phase number 1 to phase
Right.
number 2. And phase number 2 can be very long. It can be up to 2 years.
Yeah.
But in between, there's always as I said before, between two regimes, there's always volatility. But once we enter and we embark in that new regime, we get another cycle. It's the last one, Greg. Like I'm not going to be around for 3 to 5 years.
No.
I think we've got gas
Yeah.
for probably another year.
Yeah.
Anywhere between 2,600 is probably a good price level around which I will become more nervous. But for now,
Yeah.
real rates will remain very low as the Federal Reserve is trying to anchor long-term interest rates around where we are today and let the inflation expectations reach their target. So real rates, the negative between nominal yields and inflation, will continue to go down, pushing gold and gold equities higher. But eventually, there will be a level around which I believe stocks will be fully valued, and I will need to pare back my exposure. But we're not there today.
No.
I think there's still another leg to the upside.
Interesting. Wow, there's some big handle numbers on gold price if it gets to there. That is some serious upside. Now, U.S. Fed anchoring inflation expectations. How successful do you think they can be? Just with so much debt out there, and there's so much liquidity in the marketplace right now. What are your thoughts on where things go from here? Do you think that allowing inflation expectations to rise? Do you think that I guess what I'm saying is, do you think they'll be successful in fighting deflation?
I don't know if they will succeed in getting inflation higher, but I bet that they will succeed at getting inflation expectations higher. Well, all I care about is not the actual inflation number.
Right.
I care only about the expectations. And the only way to get the expectations higher in a flat, let's call it a flat oil price environment, it's to allow the US dollar to crash. Okay? Yeah. So they will let the US dollar go. We're seeing some stability right now, but this is just like a pause before we probably go a little lower. And the weaker US dollar is like a bottle of oxygen for the other economies. And this is normally the fuel that you need to get global growth moving to a higher level and create more inflation expectations. Right. And I think this is how they're going to do it. And this is something that I believe the market is monitoring very closely, because as soon as we get to the 2.3, 2.5 level on inflation expectations, the Fed will probably do a tapering when it comes to its monetary policy, meaning maybe reduce the size of the quantitative easing. Okay, but we're not there, Greg, yet. Yeah. But they will probably try to get the final push in inflation expectations above the 2% level by letting the US dollar go down. And by ricochet, this could prop up the Canadian dollar by default a little bit higher than our target of 75 cents. Yeah. It's really not the strength of Canadian fundamentals driving the Canadian. It's the weakness of the US dollar.
Yeah, I know that's been driving some of my clients crazy right now. They're going, why is the Canadian dollar going up? And I have to turn on its head. It's not necessarily the Canadian dollar is going up. It's the US dollar is coming down, especially as we gone more from a risk-on atmosphere to the risk-off atmosphere that was happening in March,
Yeah.
where everyone runs to the U.S. dollar. So what I'm hearing from you is we've got a couple of things happening. Is on the U.S. dollar side is not only do we have a risk-on atmosphere, which is usually allows for a weakening U.S. dollar, but also inflation expectations are going to rise, and the U.S. Fed will consciously allow that to float a little bit here.
Yeah.
Yeah.
Yeah, and that's obviously a form of reflation. Call it market-based. Like we know about the monetary policy rates.
Yeah.
We know about the fiscal policy.
Yeah.
Checks. But
Yeah.
people forget about what we call market-based reflation. Like when oil is going up, that's a tax. That's
Exactly.
a tightening. When the dollar goes up, it's a tax.
Yeah.
When bond yields are going up, it's a tax. If all three are going down, it's a tax cut.
Exactly.
So that market-based reflation is something that people not often talk about, but this will be very powerful. But because it's a third overlay on top of the monetary and the fiscal.
Yeah. Interesting. Well, hey, why don't we wrap it up there? Thank you so much for joining me. Always good stuff on these, and thank you. And please join us again. Thanks very much, Martin Roberge.
Thank you. Bye-bye.
Bye.